Today's market call is presented by FactSet, financial data and analytics powered by tomorrow. Beautiful afternoon here on the East Coast, 1 p.m. New York time. Dan Nathan coming to you from the West Coast. I believe you're in San Francisco, which means you're 3 hours behind. But regardless, this is still the market call. And in just a few minutes, the great Carter Worth will be joining us. Good to see you, Dan. Good to see you.
Yeah, I feel like I've missed you guys on the market call this week, so I'm glad to be back. I had a really interesting week. We'll get into some of it as we're talking about the markets. I was at Goldman Sachs's tech conference. I think they call it Communicopia, guy.
Communicopia, yes.
Back in the day, when you worked at Goldman, I don't even think there was a tech sector. It was like IBM and like Sun Micro and maybe
all true.
Yeah. But it was a great conference and a lot of stuff going on there. And I know you guys talked about the reversal in NVIDIA yesterday. I think it had probably less to do with what Jensen Huang said there and more to do about what maybe one of their big customers. We'll talk about that in a little bit, Guy.
I think it was a lot of, the Oracle quarter, if you go and sort of rehash it or look at it, it was obviously pretty positive for NVIDIA. Now, with that said, the next day, NVIDIA didn't really trade on it. I think they were waiting to hear what Jensen said yesterday. Yeah. He didn't say anything all that negative. He was pretty upbeat. And then I think that coupled with the reversal in the broader market, the move in dollar yen, which we talked about yesterday as well, it all sort of got things back off to the races. With that said, let's throw up the rundown because Amanda has outdone herself yet again. Ready, set, cut. I mean, that's so good. Gold breakout or fake out. See the way I did that? I mean, That's so Amanda Diaz. Buying defense and Adobe earnings preview. So let's take a look at a couple things here before we bring in Dubs. So unless you want to bring them right off the start.
That would be that would be Carter Worth. Let's give him 2 minutes because right before we went on, Guy, he was kind of getting his whole system set up
don't want
here.
To rush him.
Let's talk about like the markets in general. So the ready, set, cut bit, right? So all eyes are on September 18th. We had data today, PPI that came in after the CPI. If you look at the CME Fed Watch tool, they're basically saying 25. Yesterday, David Solomon was interviewed by our good friend Scott Wapner on the halftime report. He was not one of the SDs on the HTR because he really brought it. It was interesting because I think he said they could make a case why 50 could happen next week, but he thinks the strong likelihood and all you have to do is look right there and say it's going to be 25 basis points. But really quickly, Guy, anything out of the inflation data, and I know you talked about CPI. But, it's not coming down hard as some might have expected. But the break evens, if you're looking at them, suggest that we're going to be well below, getting to 2.5% in the not so distant future as far as inflation. So just again, is it the Fed and what they might do driving the stock market right here, Guy, or because it's pretty well telegraphed at this point?
Yeah. So all good points. By the way, today we dropped our podcast. Danny Moses and I sat down with Mike Wilson, and that came out today. And we had a whole conversation about everything that you just mentioned, break evens and those things. So if you want to hear further in-depth conversation from somebody who knows this in and out, check that out at your favorite podcast store, number one. Number two, yes, David Solomon made those comments. It's interesting. Richard Fisher, the ex-Dallas Fed president, was on Squawk Box on Tuesday. And when asked by Becky, I think it was Tuesday, when asked by Becky Quick about the exact same thing, 50 basis points, he channeled his inner fast money and said for two reasons he didn't see that happening. One, politically, it would probably not fly. And he said flat out that obviously the Trump campaign was going to rail against that, saying it was politically motivated. Whether it was or not doesn't matter. We have said that as well. And then two, what would it signal in terms of what they were seeing and maybe some of the concern they have that the market's not seeing? And he was worried that a 50 basis point cut might spook the market a bit. Two concerns that I've had as well. So I think 25 is right. So to answer your full question, I don't think it's about the Fed anymore. I mean, I think, the Fed, they've telegraphed very well, by the way, what they want to do, what they intend to do, and what they're going to do going forward. So now it's about the data, I do believe. And if you look at the CPI, listen, you can say it's cooling. It is, but it's sticky as hell, and it still remains problematic. And the things that are sticky are things that are going to remain sticky, and that comes in the form of owner equivalent rent and a lot of these insurance premiums that are just not going down. And quite frankly, they're not probably going to go down in the foreseeable future. So that's a bit problematic, but with all that said, it's a long-winded say of, I think, 25 basis points is what's going to happen
Yeah,
next week.
I think to your point, like we go back and forth. What does it really matter? We've been talking about the long and variable lags, you know what I mean, of monetary policy that was on the way up with rates. And, we didn't really start to see a slowing of the economy or a meaningful decline in inflation until a year and a half after they started raising rates, right? And so, like, the idea that it's going to be some sort of thing that helps the economy immediately is not the case. The one thing I'll go back to is that, if you think about what we heard from S&P 500 companies, you know what I mean? There was nothing that really ratcheted down expectations for earnings this year or next. We just haven't seen that yet, right? And so we've seen a very mixed picture about different parts of the economy that are driving the stock market. You know what I mean? Again, very narrow, and we know all that. And the narrow, contribution to the performance of the major indices is also narrow as far as the S&P expectations. And I know you guys hit Butters yesterday a little bit, but he's been tracking this, that we actually have seen a broadening out of the earnings picture away from the Mag 7. I think we covered that last month or so. And that's more important than, I think, the stock market performance broadening out, right? If you think of, so again, that's something that we're going to have to track as we get into Q3 earnings in the not so distant future, because what are we, 2-3 weeks away from the end of Q3, guy?
All right, and I want to go back to, again, the conversation we had with Mike. Hopefully folks have listened to it or will listen to it, but he spoke about earnings, earnings expectations, and how, given all the factors that go into it, the earnings expectations are excessive, in a word. I'm choosing that word. He didn't use that word, but he thought there was a bit of a pipe dream. So he also thought that at 21 times, the market in this environment is pretty expensive. And, he thought somewhere between 17 and 19 was probably more reasonable. And we had a pretty in-depth conversation about that as well. So I encourage folks to definitely listen to that, because it's a lot of Mike Wilson. I tried to push back as best I can, but obviously I agree with a lot of things that he said. I will say this quickly. What Mike's point was, although the S&P, and I think we've made this point a number of times as well, seemingly hangs in there, and it does if you look at where we are now. I mean, below the surface, there are things that are happening that should be concerning, not least of which, by the way, moving these defensive stocks, which we will talk about, and obviously the move in utilities, both signaling, I think, an underlying concern about where things truly are.
Yeah, and we're going to hit gold in a second, but when you think about these defensive sectors, whether it be staples, whether it be telcos, I know Carter's going to come in a second, and he's going to talk to us a little bit about some of those names, whether it's utilities. I mean, they were acting well when the market was going down, which you would expect, right? They were acting well when the market goes up, and that's the same thing for your gold also. So that just tells you that there is an underlying bid for defense, because as the market goes up, people are concerned about valuation, right? As the market goes down, they get more, kind of emboldened to kind of power into those things. The last thing I'll say is that the S&P is up 17% on the year. So all of the trepidation that we might have over a rate cutting cycle, whether inverted yield curve, whether, what it means to be piling in defensives, the market's still up 17%. And that's, I think, the most confounding thing. And to Mike Wilson's point, and to your point, until we start seeing estimates being ratcheted down for this year, basically saying that, analysts and strategists are way too rosy, right, about S&P earnings, and then they start taking down 2025, the market just hangs in there. And it's confounded me too, Guy. And then if you just look at, the equal weight, which S&P, which acted much better, right, than the market weighted one when we just sold off those last couple of weeks, you'd say, okay, there's a clear broadening. That's all. I'm not making a strong case for buying, trust me, for buying the market up here. And then if you see, and maybe they can pull up the Russell 2000 really quickly, look at this thing. We talked about that breakout after that long consolidation. We broke out in July, made new highs. And as soon as the market started getting a little funky, it sold right back off. And we got right back into that consolidation. And we really are back at that, 2100-ish level in the RTY. You can see where it is in the IWM. But that's not confirming any broadening out, I guess, is the one.
No, it's not. We had that conversation a little bit yesterday, that obviously cascade lower on August, crescendoing on August 5th for reasons we have discussed a number of times. A subsequent bounce with the broader market. But here we are back at levels that had been resistance. And if Amanda, real quick before we bring Carter in, you can go back and look longer term. You'll see that sort of 208 level in the IWM had been resistance for a long time.
Yeah.
We obviously finally broached it on the upside, only to come right back to it. So now there's going to be this tug of war effectively at the 150-day moving average. We'll see how it plays out. But again, if things are slowing, regardless of what rates do, I'm hard pressed to understand how the most economically sensitive names out there are going to do well. So that's sort of and that's been my take for quite some time.
And I think under the surface, as you said 5 minutes ago, that makes perfect sense. The only thing that's not lining up with that is the S&P 500. Even when we sell off 5%, it feels like we can't get going. All right, let's bring him in. Carter Worth of Worth Charting. Carter, how are you, man?
How are you? Good. I'm good.
Well, here,
please.
Jump ball. Like, you just heard us speaking for a few minutes here and all this stuff. Like, anything stick out to you? Because again, I think your work is saying lots of cross currents, but away from the qualitatively, like, where's your mindset about what's going on in the market right now as we get towards the end of Q3?
Yeah, if you think about it, obviously money flow, the study of where money is moving is what the study of price action is, what study of charts. And yet, whether you're doing it that way, or of course you're doing it as a fundamental strategy portfolio manager, trying to figure out your overweights and underweights, we do know that 98% of all capital is long, which is to say, shorting, while it can be levered, is a small endeavor. Basically, people are long America, the big endowments, the big pension plans, the big family offices, and the small church or synagogue or museum. It just long is the game. And many people by mandate have to be fully invested. The individual doesn't, nor does maybe the small museum, but professional institutional money managers cannot hold cash. There's other people who manage cash. And so definitionally, it's just this sloshing around, right? As money comes out of, if someone's worried about a semiconductor or worried about Google, maybe it's the cheapest one of the Magnificent Seven, but they're worried about regulatory risk, whatever. They are stuck in this situation where I got to put the money to work. And we've seen that a concomitant move. We publish a lot on this for clients in very dull, uninteresting, bond-like proxies that have no essential earnings growth on a long-term basis.
Speaking of dull and uninteresting companies, it's remarkable to me. And again, if you had asked me this over the last 40 years, how would AT&T and Verizon have performed when they've basically been the mirror image of one another? And you brought some more work forth to sort of take a look exactly that. But look at this chart, goes back to the early 1980s. They're basically both up 480% over that time. And outside of maybe a period where AT&T did a little bit better in the early aughts, I can't even believe I just said that. I mean, these things have basically been in lockstep, Carter. So walk us through why you bringing this up today.
Yeah, so we did two trades. One was a Verizon long trade, and then the other was basically making the case as a pair that AT&T is ahead of itself. But as depicted here, they are very similar creatures. This is a 50-year comparative chart, very straightforward, very approachable, two colors, and we see what it is. Now, let's roll through the more immediate. Is AT&T ahead of Verizon? Well, this is a year-to-date chart. Let's do the one-year chart. Let's do the two-year chart. A lot. Let's do the three-year chart. Okay. And so the thinking here is that as a pair, and a lot of people don't do pair trading, it's a perfect pair to fade AT&T and buy Verizon. But independent of that, if one is a long-only player, and most people are, just look at the two charts of their stocks individually. And so we might have those, which would be a chart individual of AT&T. Now look at Verizon. And what we're going to do here is we're going to toggle AT&T far above 150-day. Verizon, a bearish to bullish reversal buy. AT&T back to a former high, inherently difficult level. And again, about as far above, this one just emerging. They have about the same dividend yield. They have about the same PE. And again, bond proxies. But we're making this the case, an absolute long for Verizon. AT&T, if you are long trim, or as a pair trade, short AT&T, long Verizon.
Yeah, so it's interesting. We just talked about these defensive sectors acting well no matter what happens in the market over the last year or so, Carter. And you've been detailing staples and utilities for a while, and I do think this is an interesting juxtaposition. I look at this Verizon and I say to myself, on a 1-year basis, as you just showed us, it's the nice long consolidation. It's breaking out. This is a stock that has a 6% dividend yield. It's got a enterprise value. Just if you kind of put together the equity value and the debt value, they're basically 50-50, right? And these are big cash generators. And some of the fundamental stuff that people would be focused on is like, what's the iPhone upgrade cycle going to look like? How does that affect cash flow and all that sort of stuff? So to me, it's always going to be the case where there's a $180 billion equity market cap and there's going to be $175 billion in debt. The only way that kind of gets offsides is if the stock goes on a meaningful run, right? And then people start looking at things like cash flow and some of these other metrics. But from a purely technical standpoint, to my eye, I see exactly what you see. I see a head and shoulders bottom. You know what I mean? And so really, is it going to be purely technical that takes this thing back towards those highs from a year and a half ago? Or is it going to be something fundamental or a combination of the both? But I think you kind of lay off the AT&T because it looks overextended to me. And a lot of people don't really pairs trade, I think, but it's a useful way to kind of, tease out what's going on. I do like the breakout here. Guy, thoughts on this? Because again, a lot of fundamental investors are going to start thinking about how do those upgrades look like? That iPhone's going to be shipping, you know what I mean? Like in the next week or so, what does it mean for the carriers?
Yeah, so it's what I like about this is if you go back to Carter said 50 years, I looked at it from the early 80s, but whatever. I mean, go back to that long-term chart and you'll see that a couple of times you've seen this relative outperformance only for it to all come back in line. And what Carter is showing you now is you're seeing a similar outperformance that invariably will come back in the line in the form of, Verizon catching up to AT&T or AT&T basically coming back down to earth to meet Verizon or some amalgam of that. But what it means in general, I would say is, I mean, if you put up, just for shits and giggles, Amanda, put up a T-Mobile chart, TMUS, over that same period of time, T-Mobile's been basically lower left, upper right, outside a brief sell-off that we've seen, I don't know, maybe over the last couple months. So that's a shorter term chart. Put up a longer term chart. You'll see exactly what I'm talking about. So what my point in bringing this up is there's been a tremendous outperformer in a space that is not done all that well. I mean, it's probably underperformed the broader market over those decades that Carter brought forth.
Yeah, I'll just say one last thing about that, Carter. Maybe you have a comment on the T-Mobile, but when you think about this company, we're talking about an enterprise value. I mean, their equity, market cap is double that of their debt, which is very different. You know what I mean? So it's less of a bond proxy and more on some of those fundamental growth dynamics and the sorts of market share gains. And I think, Guy, this is a stock that you've been championing as long as I've been doing fast money, to be honest with you. And I think for a lot of those fundamental reasons, they've been taking share from AT&T and Verizon, and they've done it with a much less of a debt load. So interesting enough to me.
One thing just about the leverage you mentioned. I mean, AT&T is the most highly indebted company in the world, if not the second or third. Also, as recently as maybe the past 5-6 years, it was the second most profitable after Apple, meaning they generate more actual net income. That's not the case in the past 4 or 5 years, but I mean, it is a massive operation, a bond seller. And so the question about the dividend, which a lot of people no one wants to be the chairman during the period when they cut the dividend, right? I mean, that goes right on your epitaph, right? That goes on the first sentence of your New York Times obituary. Bob so-and-so, who cut the dividend for the first time. And so they'll do anything they can to not let that happen. And I'm not to say that maybe the dividend won't get cut, but these are basically secure dividends. And so it's important to think of that. But the T-Mobile, different animal.
The whole foundation of those companies is in fact dividend. And you're right. I'm hard pressed to believe that's happening anytime soon. And, in terms of AT&T, a couple misguided deals that they've made have really obviously hurt performance. Okay, got it. Now, Dan's out there. I believe you saw the David Solomon, Jensen Huang interview. Let's put up your NVIDIA chart, Carter, because once again, this uptrend to the penny, as they say, in terms of where it traded down to and what it subsequently has done.
So that pink line is actually to the penny where the 150-day moving average came into play. It was the 6th of September. We put out a poll at that moment at $100 a share, and you see the results there. Basically, people skewed to the positive. So marketplace was right, at least in terms of participants anticipating a bounce. Interestingly, institutional clients, portfolio managers, traders, and analysts, CIOs, economists, that kind of thing, were a little less sanguine than individuals, but bounce it has up 17%. Here now, I would be long and sell calls.
Yeah, so interesting. And just we have our own chart, Carter. That again, it looks the same as yours, but it's interesting when you look at the 150-day, as you like to do, and you would point this out, even if you weren't going to draw that uptrend. You see where it found support, to your point, over and over again, and we just drew that line. I don't know if that series of lower highs is important to you or not, but you see that you have this sort of situation. I think you'd probably call it a pair of twos. That's why you're selling calls against long stock, right? And really interesting to see from a technical perspective if it gets back up to that kind of 129 level or not. One of the things that I would just say about the takeaway from the conference yesterday at Goldman is that obviously this is the 800-pound gorilla in the room as it relates to the entire, generative AI trade, right? We know that we've had some of these we've had some of the hyperscalers. They're really important in their CapEx. And one of the stories that I think got the stock going, it wasn't what Jensen Huang had to say yesterday morning at Goldman, because it seemed a lot of the same of what they said on their conference call on August 28th. There was a headline out of the information, or a story out of the information, that, Meta, which is one of NVIDIA's largest customers, is building this 100,000 H100 GPU cluster that's going to be this massively powerful, data center to train their llama, but also have, a whole host of other things as it relates to their business. That's really what got it going. And, if Blackwell push out, that's the next version of this high-end GPU that NVIDIA is making. If that was the thing that took it down after the results, the fact that, Meta is building this huge cluster on the old, technology. When I say old, it's not old, people are still clamoring away for these chips. That's what really got, I think, NVIDIA going yesterday, Guy.
I agree with that. And I think the market wants to believe the story, and I get it. And he tells a great story.
Yeah.
But there are people that are starting to punch holes in that story. And as we said, we've had a couple conversations around sort of the companies around NVIDIA, all those sort of adjacent names have really been under pressure. And at a certain point, and I'm not a hater, I'm just trying to go back and look at history. I think math sort of catches up to this thing. And whether it's this next quarter or the quarters to come, I think the market's setting itself up a bit here in terms of their expectations and the thought that they can continue on this trajectory, Dan.
Yeah, no doubt. Carter, really quickly, maybe Amanda can pull up Micron. And so this stock got downgraded today by BMP to a sell. It's the only sell in the name. I think there's like 40 buys, 2 holds, and 1 sell. And Guy, I can't remember the last time people were so bullish on this stock, despite the price action. It's round trip this whole move. Yeah. Carter, when you're looking at the rally that we had in August off of the lows, right? We got back towards those highs in the S&P. We never got back there in the NASDAQ. And then you look at some of these stocks that, Google slashed through its August 5th low, recently. Look at this thing back towards its August 5th low. How do you make heads or tails of these stocks that are much loved? And we could throw Dell in there and Supermicro, and they're all related to the Gen AI trade, that are really having a tough time getting going here.
Yeah, I mean, it just speaks to what a risk asset is. I mean, to think that basically you can go from 80 to 160 to 80. So it throws every premise out. I mean, anyone who's sitting there, he's working on his DCF, she's working on her dividend discount model, or enterprise value EBITDA. She's trying to figure out 4-year growth rate. What's the multiple sign? Then he's got to work on the 10-year yield and figure out, okay, what? You're like, are you serious? Maybe we should just make a peanut butter and jelly sandwich instead, because that's a little easier. 2 pieces of bread, put things in the middle. 80 to 160 to 80. I don't like it. I wouldn't want to play this for a bounce. But I think the more important thing, what I'm trying to say is, one of the things about Wall Street is that they act and sound very officious and very informed. And look, they're just individuals, many of them with big degrees and big talent. But we're talking about something that everyone knows. We're all doing one thing. What? Predicting the future. Hard thing.
Very hard thing, but you do it extraordinarily well. We are fortunate to have you, the great Carter Braxton Worth. Thanks for joining us. I don't know if I'm
Thanks,
seeing you on
Carter.
Fast Money today, but we will see you next week, brother. Thank you.
Thanks,
You
dude.
bet. Bye.
Guy, by the way, so let's do a little inside baseball here. You and I grew up professionally on trading desks. And, people say, why do these traders, over time, they just get fatter and fatter, right? And I'll tell you one of the things, what does everybody tell you not to do, whether it's a nutritionist, whether it's your mom or whatever? Don't eat fast, right? They said that's really bad for you. But one of the things when you're on a trading desk, you only have a limited amount of space in front of you, and you got to use your hands on the phone, on the computers, right? And they said, whatever. So what do? Why? We don't eat salads. You know why? To eat a salad probably takes like 40 sort of bites. You eat a sandwich. And I got thinking about that because I went through a period, I think it was like in the early 2000s, where I was just ordering, I don't know why, and I'm not like a 12-year-old boy. I was eating PB&J sandwiches every day for lunch with chicken noodle soup, but I could get through it really quickly, move it aside, and get back to trading. Is that something that you recall here, guy? Yeah, I'm just saying. I mean, that was a thing.
PB&J.
Every once in a while, the deli would be like, back then there was no Uber Eats. We had to call them, you know what I mean? And they'd be like, we're out of strawberry jam. How about grape? And I was like, no, I'm out. And I hate.
I mean, not that anybody particularly cares about, my trials and tribulations, but I eat, and this has been going on now probably since college, but I might eat once a day. And you've seen this firsthand. Like, I'm not a big, like, I love food. I just don't eat. So,
bizarre.
We didn't really eat. There were no real lunches back in the day because how are you going to get lunch? I mean, nobody was bringing.
No, your assistant would run out. Well, hold on, guy. My first job on a trading desk, I had to run downstairs. We're in Stamford, Connecticut. It was SAC. GE Capital was in the building, and they had a cafeteria every day. I had to go down and get this sandwich, the same sandwich for this guy that I worked for. And then this woman, she was a girl back then, was his first assistant. I was a second assistant. And I'll tell you, to this day, I remember, this was 25 years ago, what I had to get for her. It was on whole wheat bread, okay, like grainy sort of bread, a thick layer of Gulden's mustard on both sides. You ready for this? Tomato, cucumber, and sprouts, whatever those sprouts are. This is like my kryptonite. Okay. If I had to eat that sandwich, I would probably just lose all of my superpowers. And then she wanted it on the plate and she would mush it together when I got up there, and it was disgusting. All right. We got lots of stories like that. All right. Let's move on a little bit.
Let's go to gold, because now
that was my bad. That was my bad.
The appetite that I didn't have, I certainly don't now. Gold is having a day, and I don't really know why today, but I mean, things are happening yet again. And we go back to August 5th. And what we mentioned that day was the sell-off made sense because when markets move to that magnitude, it's a risk-off day. Everything gets taken to the woodshed. But what we thought would happen and subsequently did, it was shallow and it was short-lived. And here we are now making new all-time highs yet again. So the gold trade is certainly alive and well. The market has tried everything it can to sort of dismantle it, or I guess derail it, with limited success. The miners are having a day as well. So I get it. The S&P looks great, but you mentioned it earlier. Below the surface, things that have historically been very defensive and very sort of, I don't know, a harbinger of things are flashing red yet again, despite the fact that the S&P at 5590, I think that's where we are right now, is within probably 70, 80 handles of a new all-time high.
Yeah, and listen, this is one where I think whether the dollar's up or down, whether the stock market's up or down, whether Bitcoin's been up or down, you've been making a very cogent case why, gold should work in this environment. It's related to some of the central bank activities, what the Chinese are doing, all that sort of stuff. So again, here's a question I'll just say, guys. So you've been a buyer on dips. You get more bullish when it consolidates above prior highs. This has been a theme for, I think, 18 months with you. What is the thing? And we've had some volatility here and there where we've had some flushes. What do you think the thing is near term that would cause gold to give back a bunch of these gains, which has been, you can just see it in this chart, lower left, upper right.
I think that is a great question. I think there are a couple things, and I don't think any of these things are going to happen. But if you were to see some sort of detente in the Middle East, if you were to see, Russia, Ukraine somehow resolve itself, if then subsequent to that you were to see the central bank filings that come out show that they've stopped or no longer buying gold to the magnitude that they bought gold, if you were to see some stabilization in the currency markets, any of those things or any combination of those things potentially could derail the gold market without question. Outside of that, I don't know the answer. I think a market sell-off, an equity market sell-off, although the knee-jerk reaction would be to sell off everything else, I think that would be bullish. So I sit here and say that, gold is very quietly doing its thing. And, I thought for a while that the environment that we were in and subsequently going in would lend itself to gold. So here we are.
Yeah, and I'll just say this, and you know this, you've been trading a long time. Especially with commodities, relative to, let's say, stocks, is there a much more narrow view on the underlying, and then maybe some of the, in this case, what the dollar's doing, what rates are doing, that sort of stuff. But if this thing were to pull back, you see where it would pull back to, because all you have to do is go back, let's say, a year, look at that consolidation. If you did it from 2 years ago, you'd see that it moved up towards that consolidation period. It stayed above that 150-day moving average, which was, support, right? And you see how it kind of stair steps. It was in that long sort of consolidation. Then it moved up, then it consolidated. It seems like we're breaking out again. But if we were going to do a back and fill, guy, it gets you probably by then to 2375, 2400 or something like that, which would probably be healthy, for all intents and purposes, and then try to kind of retake those prior highs. And I'm just kind of pulling that out there just because it would make sense from a technical standpoint.
No, you're 100% right in bringing that up. I don't see that happening, but it absolutely could. And if it does, by the way, it's probably going to do it in a very swift manner. So we shall see, Dan.
All right.
We have a couple things we want to get to before we go to the couple questions we have.
Yeah, no doubt. I just want to say this. So I'm out in San Francisco, and it's interesting. I had a very interesting experience because last summer I met a woman who works for Waymo. Waymo is the self-driving company. It's part of the Alphabet portfolio of companies. So it's self-driving cars. You've been seeing, stories about these things. You see pictures of these cars with all these big things hanging out of them and this and that, whatever. And I've gone in a couple over the last couple of days, and it's a pretty crazy experience. Now, Guy, I know you play the Luddite on TV and everything like that, but even someone like you, if you took the application on your iPhone, okay, and you called up one of these things and it showed up right in front of the restaurant or the hotel that you're at, and then you hit a button that says unlock and you get in there and it knows where you're going and just takes you there. It's like the craziest experience, and let me tell you what Waymo's using right now. They're using these Jaguar, nice cars, right? They're like these SUVs. They're clean as can be. You get in there and it just takes you there. It's pretty, I'm just saying, it's pretty fascinating. And so we've been talking about, you say this all the time. What are the names that you want to buy if you get that sell-off? What are the names that are underperforming? Waymo within Google, which is, like a $1.5 trillion market, whatever the hell it is, is maybe valued at 50 billion. It's a rounding error. You can make the case, is this a business that could really scale? Because those cars that you're talking about, it's a luxury Jaguar. It's really nice. The technology, the LiDAR and the cameras and all the AI and all this sort of stuff, the customer service, kind of expensive. The question is, does it scale? You know what I mean? And who knows? But all I'll tell you is right now, this is working in this town. And what's interesting is that the wait times for Uber are longer for those than Waymo. So what does that say to you? Like, there's potential disruption. And the last thing I'll just say about this is October 10th, Elon Musk, Tesla, they're hosting this robo-taxi event. Okay. Well, what are robo-taxis? That's going to compete with like a Waymo, and they're using very different technology than the LiDAR. And supposedly what they use is going to scale better than the LiDAR and the Waymo, but they're not there yet. They don't have full self-driving, and you have to believe in full self-driving and autonomy to justify the market cap and the valuation of Tesla. So I'm just saying that this is an oncoming battle. I think October 10th, guy, is going to be fascinating. Take every iPhone launch event, and I know you look at every one of them really closely, okay? Every iPhone launch event for the last 10 years, roll it up into one, and that's, I think, going to be the significance of this October 10th meeting. And we'll take a much closer look at it, as we get, in the next couple weeks or so. But I mean, this Waymo thing is really interesting. And the last thing I'll just say before I give it back to you is that I've been looking, we've highlighted the underperformance as it relates to Google. We understand the competition as it relates to their large language models and Google Cloud and all this other stuff. But every once in a while, these moonshots that they've been talking about for 15 years, can kind of pay off. And this Waymo is, I think, something really to watch, guy.
Without question, I think you're right in bringing up, its market cap in relation to what Google is. With that said, though, I mean, if they catch it, it's one of those, to your point, it's one of those moonshots. With all that said, the chances of me ever doing something like that are absolutely, there's just no,
Well,
I'd rather effing walk to where I'm going.
I know, but I'm going to promise you this. You and I travel together a lot. If we are ever in SF or Austin or LA, where these things are right now, I'm going to convince you. I'm going to say, hey, bro, let's go grab an Uber. We got to get to here and there. And it's going to be a Waymo, and you're going to get into it. And you're not even going to know it until you get into it. And I'm going to keep you hostage in there. What do you think, real quickly, of the Google guy? We've talked about the valuation. It's nearly a $2 trillion market cap. Let's say nothing to do with Waymo. It really is in the hands of Google Cloud, the adoption of these large language models. And the last thing I'll just say, what's so different to me about, let's say, Google, their Gen AI strategy as it relates to Microsoft or Apple or Amazon, they have 9 properties. And you know what they are? It's Gmail, it's YouTube, it's Android. I mean, the list goes on, with over 1 billion users. Half of them have over 2 billion users. If they can deploy their Gemini across those platforms, create better engagement, better search results, better YouTube, all of the above, they're going to be, to me, one of the biggest winners of this Gen AI story, guy.
Well, Google, we've talked about it. It's obviously had some pits and falls. I mean, it just made an all-time high, I think, on the 5th of July, like a lot of these companies, by the way. I think probably Microsoft is in that camp too. And it is sold off. The level that we've gotten down to, if Amanda can do a longer-term chart, you'll see the prior all-time high way back in the fall of 2021 was basically 150-ish. And that's where we traded down to over the last couple of weeks or so. So past resistance becomes support, and there's the chart there. I sort of, call me crazy. I think you can buy. I know that it's breached the 150-day. I get it. First time, by the way, in a while, and remaining below it. But I don't know. This is one, you're looking for places to buy Google, not sell it.
Well, yeah. And I think the other point would be, okay, you just mentioned it, that 130 level from March, if you were to start buying it, let's just say below those recent lows, just call it, that gap fill, you see that from March, guy, that's probably what, 143 or something like that. Let's just say you have the patience, you buy a little there, you start buying it on the way to 130. Maybe the ultimate low is that October low, 120. But when you think about what was going on then and the pessimism around, their Gen AI, I mean, listen, I think that between 140 and 120 dollar cost averaging there, I think you're going to be very happy a year or two from now. And the last thing I'll just say, you mentioned valuation. Stock trades at 17.5 times next year's expected earnings growth of 13%, sales growth at 10%. The problem right now is their margins. They've gone down from like 68, 69% to maybe 63% this year and maybe 62% next year. Why is that? The investment that we're just talking about in this technology. Now, if they start getting the leverage on those investments in 2025, it might be late 25, it might be 2026. You're probably buying this at the right spot for a long term. That's all.
And real quick, and this is sort of adjacent, but not. But I think one of the things that Jensen Wang said yesterday was, for every dollar people are going to spend, they're going to get $5 worth of return. Now, whether that's true or not, we will see. And that's the hope and this whole ROI in terms of the spend in this space. We'll see how it plays out. Couple questions before we 5,000, because I got to head in the city. Chris L says, Amanda, throw this up. I'm not even going to read it here. I'll let Dan read it. Throw up Chris L's comment.
Why guy was on the trade desk, you had to mail your buys.
When guy was on the trade desk, you had to mail your buys and sells. That's Chris making fun of my age. I appreciate that, Chris. It's very amusing.
No, but didn't you start in the business as a runner? Because they used to have that ticker tape.
I was on the floor of the Mercantile Exchange, that we call it the COMEX, on 7 World Trade Center. For you people that have watched or enjoy the movie Trading Places, the last scene in the movie takes place the second to last scene. The last scene takes place on a beach, but the second to last scene takes place on the floor of the exchange, filmed on a Saturday. And that's what I did for about 8 or 9 months.
All right, guy, really quickly, and I know you got to go because you got a jackass in the city, but one of the feedback we get all the time is people like the kind of inside baseball, like some of those big stories. Really quickly, in 1997, the guy that I worked for, you remember the one that I had to go down and get a sandwich every day, and the woman that I had to get her sandwich? Yeah. All right. So we went to the CME, the Chicago Mercantile Exchange, one of our fine sponsors, and this guy Adam wanted to trade. Sitting up like on the so the pit down there, you had guys in the pit, okay, then you had guys around the pit, okay, and then you guys had up above but still in the same room that were on the phones taking the orders from the customer. So we sat right next to our broker who used to take our orders from where we were in Connecticut, and then he would sign. You probably used to do this at the COMEX. He would sign the order down to the guy who's standing around the pit. That guy would write a ticket. Okay. And then he'd sign to the guy in the pit, and then he'd sign it back to him what the thing is. And then they used to do this thing. They had these cards and they used to flip them like that. Do you ever see that? And they used to literally do it like a Frisbee up 10, 15 feet or whatever. It was truly fascinating. We spent the whole day there. It felt like that second to last scene guy in Trading Places where everything was really frantic. Then they turn it off. And then everything shuts down a little bit. Well, and one of the things I want you, the last thing we saw this, it was fascinating. There was disagreement over prices because you were not putting them into a machine right away or whatever. And at the end of the day, these two guys had each other like a hockey fight, like they were fighting over a price. Was that you back then?
That people say, how did it work? Yeah. You think about it, but you just mentioned how it worked, because if you tried to get over on somebody, you might be able to do it once, but the next day, nobody was going to trade with you. So you basically were ostracized and you were shut out. So, yeah, you might get away with it one time, but it was self-regulating. And then, two, to your point about flinging the cards, the guys, and I say guys because it was 99% men, in the middle of these pits that would collect them, they used to wear goggles because some of these psychopaths got so good, they could actually hit these MFers in the face. And that was a bit of a game as well. So there you go. Quick last question. Guy, where do you see dollar yen? I think it was in the next 24 months. So Elizabeth talks about this, and I agree with her. If you do the math back of the envelope, dollar yen's probably going down to about 134. So the yen is going to strengthen to about, if you go longer term chart, not that it matters, but that's where I see it going. And I will tell you, I think if that were to happen, the equity market's probably not going to like it because it suggests a risk-off event, and I think it's going to happen a lot sooner, Dan, than 24 months. A couple of house cleaning or keeping things. Monday, we drop the On the Tape podcast. That will happen. Tuesday, we're both in Washington, D.C., so we are not doing the market call on Tuesday of next week. I think what we're going to do instead is a market call on Friday of next week. Am I missing anything else?
No. So we're going to do it, to your point, Wednesday, Thursday, Friday, 1 p.m. Eastern. You and I are going to be participating in a great event at the Pissarro Center for Financial Markets and Regulation. And Guy is an alum. They can't wait to get Guy back up there on the hilltop. And he's going to be interviewing CME CEO and Chairman Terry Duffy, great friend of us, a great sponsor of ours. That's going to be fun. And we'll kind of report back on some of the things we hear from there. There's going to be a lot of regulators there, a lot of market participants. It's going to be really cool. So excited for that. So that's it, Guy.
We wanted to do market call. Logistically, it's just too difficult to do. Yeah. So just stay tuned. Yes, one other thing. Market Matrix, obviously. We don't need to throw the graphic up, but check that out. We're doing, people seemingly enjoying it. And remember, the typical On the Tape podcast that drops on Fridays dropped today. That's Danny Moses, that's G Swizzle, that's Third Person, and it's Mike Wilson. A 55-minute wide-ranging conversation about a lot of things we talked about now, but much more in depth. So check that out, because anytime Mike Wilson speaks, whether or not you agree with him and that doesn't matter, you should listen to him.
Yeah, that's the head equity market strategist and much more over there at Morgan Stanley. We think he's one of the most brilliant guys in the market. We love sitting down and talking to him. I was really bummed to miss it, but he comes on every quarter with us, so I'll be there.
We had him on June 28th. We had him on yesterday. That means in December is probably next time we'll get him back.
All right, man. Thanks for being patient with me in this remote setup here in San Francisco. I'm going to see you on CNBC's Fast Money. I'm going to
Big
be
show.
from the One Market. That's the SF Bureau for CNBC. I love always broadcasting from there. So I'll see you there later. Thanks, everyone.